By the Chairman and Ranking Member of the Committees on Financial Services and Agriculture, the joint subcommittee hearing will come to order. The agreement provides that today's hearing will be in accordance with the committee rules for the Committee on Financial Services. However, for the purposes of recognition, for opening statements and for questioning, I will recognize first the Commodity Markets, Digital Assets, and Rural Development Subcommittee Chair and Ranking Member, and then proceed to recognize myself and Mr. Lynch. Then the respective Chairman and Ranking Member of the Agriculture Committee, and lastly, the Chairman and Ranking Member of the House Financial Services Committee. From there, the questioning will alternate between Republican and Democratic members of the subcommittees, with the members on Commodity Markets, Digital Assets, Rural Development recognized first, and then the members of the Subcommittee on Digital Assets, Financial Technology, and Inclusion. We'll then proceed in the order of seniority. Without objection, the Chair is authorized to declare a recess of the committee at any time. This hearing is entitled, "The Future of Digital Assets, Measuring the Regulatory Gaps in the Digital Asset Markets." Without objection, all members will have 5 legislative days within which to submit extraneous material to the Chair for inclusion in the record. I will note at the outset that this hearing has a hard stop at 1 p.m., which we will strictly observe. With that, I will now recognize the gentleman from South Dakota, Chairman of the Subcommittee on Commodity Markets, Digital Assets, and Rural Development, Mr. Johnson, for 4 minutes.
Mr. Hill, thank you. And it is historic. There are not very many times that we do things together like this in this town, but I think this is altogether appropriate. And it's, you're right, this is an august hearing room, there's no question. Frankly, if we're going to get the kinds of progress that we need to get, we're going to have to do it working together. And I think our committees have been working together for weeks and months now, trying to make sure that that we bring certainty and sensible compliance to the digital asset space. We know that digital assets and the blockchain technology hold real promise, from facilitating payments to increasing data privacy and managing supply chain logistics. These networks represent a new way for individuals, a new freedom for them to make better business decisions. However, current federal laws and regulations provide few rules of the road for those who want to engage with those emerging technologies. I think all of us know the current uncertainty does not serve us well. It doesn't serve the marketplace well. The CFTC and SEC continue to debate whether certain digital assets are securities or commodities. Those conflicting enforcement decisions create further confusion in the industry and the market, and I thought our hearing folks today in their pre-filed testimony did a good job of explaining how problematic that has been. Collaboration between our committees will allow us to answer the important questions that face us, and congressional action is essential to provide clear rules of the road and robust oversight for digital asset market participants and intermediaries. The right policy solution involves both committees speaking with one voice to appropriately direct the CFTC and the SEC to each focus on what they do best. Market participants will benefit from the long-standing investor protections in securities and commodities markets, but they will also benefit from new ideas, new services, new opportunities that innovation can bring. Our central question today is how best to promote both advantages. We can do that, and we must. Governments around the world are grappling with these same questions, and they are coming up with answers. One of the pieces of testimony, I think, noted that most of the G20 countries are ahead of us, because in the absence of U.S. leadership, they're creating frameworks and establishing themselves as hubs for the development of the digital asset ecosystem. Just last month, the European Union approved its Markets in Crypto Assets, MiCA regulation, and that really became the first comprehensive framework for digital assets in the world. And as the use of these assets grow, Congress must speak clearly about how best to regulate this growing sector to ensure the United States remains the leader in financial and technological innovation. Today's hearing will get us quite a little bit closer to that goal. Thank you to each of our witnesses for their willingness to share their expertise, knowledge, and time with us. I look forward to hearing your perspectives about the current regulatory obstacles to the digital asset ecosystem and hearing your thoughts on solutions. And with that, Mr. Chairman, I would yield back.
Gentleman yields back. Thank you. I now recognize the gentlewoman from Colorado, ranking member of the Subcommittee on Commodity Markets, Digital Assets, and Rural Development Subcommittee, Ms. Carvalho, for 4 minutes.
Thank you, Chairman Hill, and I want to extend my thanks to you, Chairman Johnson, and Ranking Member Lynch for helping bring the Agriculture and Financial Services Committee together for a joint hearing this morning. During a recent Agriculture Subcommittee hearing on April 27th, we discussed the spot market regulatory gap, avenues to strengthen customer protections, and the need for sufficient resources and funding mechanisms to support these efforts at the CFTC. Any legislation that passes Congress must, of course, address these issues. But the sprawling nature of the digital asset industry also highlights the importance of cross-jurisdictional cooperation and communication. That is why I'm happy to be here today with my colleagues from the Financial Services Committee. The Biden administration has supported this collaborative approach too, through issuance of an executive order titled Ensuring Responsible Development of Digital Assets, which called on federal agencies to work jointly to issue reports on a variety of subjects, including a report issued last October reviewing the specific financial stability risks and regulatory gaps. I hope the success of that joint effort will be echoed in today's hearing. The scale of digital asset activities has increased significantly in recent years, both in terms of market participation and use cases. And while our federal financial regulators have successfully utilized their existing enforcement and regulatory activities, we still see charges of rampant and willful noncompliance with some of the biggest market participants. Ultimately, providing regulatory clarity to the digital asset industry must also support a robust enforcement regime and prioritize market participants. Finally, there have been concerns raised as to whether the CFTC has the resources needed to regulate the digital asset spot market. I would like to note that this is not the first expansion of the Commission's authorities in recent years. Post-Dodd-Frank, the Commission successfully wrote and implemented rules that expanded their authorities in the swap market. Further, as the digital asset industry has grown, we have seen the agency dutifully exercise their enforcement authorities. Yet, if we value increased action in the spot market, we must value those who do the work for the taxpayers. I strongly believe any digital asset legislation passed by Congress must include a funding mechanism for the CFTC. With that, I would like to thank our witnesses for joining us today, and I look forward to our conversation. And I yield back, Mr. Chairman.
I thank the gentlewoman, and I now recognize myself for 4 minutes. Again, thank you for joining us today at this historic hearing on digital asset market structure. Like Chairman Johnson, I want to celebrate collaboration on Capitol Hill anytime it happens. And so we're grateful for the House Agriculture Committee for partnering with us in this unprecedented joint hearing in working to craft legislation, and to our Democratic colleagues for working with us through today's unusual circumstances in this joint hearing. What we decide to do in this Congress this year will shape whether or not the digital asset ecosystem has the opportunity to thrive here in the United States. But right now, there's not a workable framework in place for digital asset issuers and intermediaries to be regulated effectively by the SEC or the CFTC. I've heard a few members in this room say that the status quo of existing laws is enough, that crypto firms are just willfully avoiding compliance with the law, and that Republicans somehow are off embarking on a partisan pursuit of sweeping digital asset legislation. But the reason I know that this can't be a partisan exercise is because my Democratic colleagues have been telling me they support common sense legislation for months. For example, just last November, our ranking member of House Financial Services Committee, Mrs. Waters, said, "We need legislative action to ensure that digital asset entities cannot operate in the shadows outside of robust federal oversight and clear rules of the road." Ranking Member Waters went on to say, "It's clear that there are major consequences when cryptocurrency entities operate without robust federal oversight and protections for customers." And my friend, good friend from Massachusetts, the ranking member of our subcommittee, Mr. Lynch, said, "While FTX may be headquartered offshore, the circumstances surrounding its collapse strongly point to the need for developing thoughtful regulation to protect U.S. investors." That's a great point. And since we can't trust offshore crypto exchanges like we saw through the FTX collapse, We want to work on legislation here in the United States for U.S. companies that will follow the rules, protect U.S. investors and consumers, and prevent future chaotic things like FTX from happening again. However, if we fail to provide a functional framework for digital assets in this country, all we're doing is forcing this activity to happen in an offshore exchange rather than in a nicely innovative, properly regulated U.S. working environment. And that will only hurt U.S. investors, innovators, and consumers. Remember, this committee worked in a nonpartisan way to have Sam Bankman-Fried testify last December before he was arrested in the Bahamas. It wasn't our decision to cancel his appearance. But the bankruptcy process will take a long time, and SBF's criminal trial in October could even be delayed. And as long as FTX remains an ongoing issue for the committee, I want to reiterate our commitment on behalf of House Republicans to work with the minority to make sure that that whole situation is investigated and held accountable. However, we can't lose sight of why both Democrats and Republicans have been calling for legislation for months. There's nothing partisan about that. To quote Senator Gillibrand, establishing a regulatory framework that spurs innovation, develops clear standards, develops appropriate jurisdictional boundaries, and protects consumers. That's why we're here today. No one here is claiming that crypto should be exempt from rules or that we should create an entirely new regime for it. Instead, we're trying to apply the principle of same risk, same regulation to amend current law to establish a functional regulatory environment. I think the CFTC and the SEC and our consumers will benefit, and I look forward to our discussion today. And I yield back. Gentleman from Massachusetts, the distinguished ranking member of the Subcommittee on Digital Assets, Financial Technology Inclusion, Mr. Lynch, recognized for 4 minutes.
Thank you, Mr. Chairman. I would like to also welcome our Agriculture Committee colleagues and thank this panel for the willingness to help the committee with its work. Chair Johnson as well. I believe there are benefits to hosting a joint forum like this between members of our subcommittees to consider policy questions around digital assets and allow all stakeholders to have a seat at the table. I do understand jurisdictional questions have been raised at times over whether crypto tokens are securities or commodities and whether the primary regulator of those tokens should be the SEC or CFTC. I worry we might be asking the wrong questions, however, and we risk feeding into industry-fueled narratives about a turf war between these two agencies. The digital assets industry continues to claim that it lacks regulatory clarity and that its products and technology don't fit into existing regulatory schemes. I believe that industry advocates make these claims because they know that the current prevailing business models for crypto are not compatible with orderly markets or investor protections law. The problem is not regulatory ambiguity, it is mass non-compliance with existing laws. We're now exploring whether we need a new regulatory structure to cover digital assets, which would likely undermine well-established laws and regulation. I worry that erecting a new law could be viewed as a light touch and encourage other industries to morph their products so that they can meet the definition of digital assets and thereby avoid long-standing, long-established investor protection and orderly markets requirements. I remind my colleagues that the U.S. has a comprehensive and long-standing framework of securities laws and rules designed to protect investors, promote market integrity, and facilitate capital formation. It is the framework that has sustained massive innovation in our financial system for decades. The SEC has important requirements to protect investors and the markets. These include laws that govern securities, broker-dealers, security exchanges, and clearing and settlement agencies. They require the companies to provide certain disclosures, segregate customer funds, keep records, protect customers, and include a whole host of other requirements. Creating a new carve-out for digital assets seems redundant and unnecessary. I encourage my colleagues to not get lost in a debate over whether individual tokens are securities or commodities. Instead, we should take a step back and examine the intermediaries that facilitate these tokens, such as the exchanges, lenders, and wallet holders. Digital assets companies want to serve multiple functions, but there are clear rules for companies that function as exchanges, broker-dealers, or clearing and settlement agencies. Some digital assets companies try to flout the rules by being all at once. Rather than comply with existing rules, various cryptocurrency firms have engaged in a legal battle against the SEC. The SEC has brought 130 enforcement actions and prevailed in every single one. They often argue that they lack guidance or their products aren't what they clearly are. In closing, I welcome the conversation that explores the potential of these products, but given that the majority of the industry has failed, I find it difficult to understand the benefits without proper regulatory compliance. Creating a separate regulatory regime through legislation is not the answer. However, I look forward to a continued discussion on this topic, and I yield back.
I thank the gentleman. I now recognize the gentleman from North Carolina, the chairman of the full Committee on Financial Services, Mr. McHenry, for 1 minute.
Well, first, it's wonderful to be on neutral territory in this little Ways and Means Committee room between the Ag Committee and the Financial Service Committee. We want to show our friends on the Ways and Means Committee how two committees can work together and produce a legislative product. But I want to thank the subcommittee chairs for working so well together with their ranking members to have this subcommittee hearing, joint subcommittee hearing. The purpose here is to make law, for us to give assurance to the marketplace and to consumers, to close regulatory gaps, to make sure that you have like-kind regulation of new things in our society and the potential they hold. We need to get this right, both for a couple of reasons. One is to harness innovation and enable consumer protection, and the other is to ensure that the CFTC and the Securities and Exchange Commission will work together to ensure that consumers are protected, unlike what is currently happening. Look forward to the panel's testimony, and I want to thank the members for joining in this little committee room.
I thank the chairman for those comments, and now recognize my friend from California, the gentlewoman, Mrs. Waters, ranking member of the full Committee on Financial Services, for 1 minute.
Thank you very much. Last Congress, I focused the efforts of this committee around addressing problems in the crypto markets. After the Biden administration testified before our committee about possible bank-like runs of stablecoins, I set about working on a comprehensive set of legislation jointly with Mr. McHenry, the Treasury, and the Federal Reserve. We made solid progress, but didn't quite get there. Treasury and our financial regulators also identified further gaps in oversight in the crypto markets, and such as limits in the SEC's authority to go after frauds like FTX, even when they operate just off the coast of Florida. These should be bipartisan concerns, and legislation to address them should have a path to the president's desk. I hope this Congress, we can quickly return to developing legislation together. I yield back.
I thank the distinguished ranking member. We welcome the testimony today of Mr. Andrew Dorgy. Mr. Dorgy is the head of Republic Crypto. Mr. Matthew Culkin. Mr. Culkin is a partner and chair of the Futures and Derivatives practice at the law firm of Wilmer Cutler Pickering, Hale, and Dorr. Mr. Culkin previously served as the director of the CFTC's Division of Swap Dealer and Intermediary Oversight. Mr. Marco Santori. Mr. Santori is the Chief Legal Officer at Kraken Digital Asset Exchange. Mr. Daniel Schoenberger. Mr. Schoenberger is the Chief Legal Officer at the Web3 Foundation. Mr. Timothy Massad. Mr. Massad currently serves as the Research Fellow at the Harvard Kennedy School and the Director of MRCBG Digital Assets Policy Project. Previously served as Chair of the CFTC from 2014 to 2017. And finally, we'll hear from Mr. Michael Blaugrund, Chief Operating Officer of the New York Stock Exchange. We thank each of you for taking time to be here with us. You'll be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statements will be made part of the record. Mr. Dorgy, you are recognized for 5 minutes.
Thank you, Committee Chairman McHenry, Thompson, Ranking Members Waters, Lynch, Scott, Subcommittee Chairman Hill and Johnson, and Ranking Member Caravillo, and esteemed members of both committees for the honor of testifying before you today. My name is Andrew Durkee, and I am Executive Vice President for Republic and co-founder of its blockchain technology business, Republic Crypto. In these capacities, I oversee Republic's strategic vision with respect to Web3, as well as sit on various corporate boards as a fiduciary. And for better or worse, I believe I'm the only panelist here that does not happen to be an attorney. While I am here representing Republic, it's important to note I also feel that I am here to represent the American people, of which nearly 83 million have or are currently participating within this industry, including millions of them who use the Republic platform. I've been in the blockchain industry for over a decade and have watched the industry grow from concepts and theories to practical deployments. To find this industry now the topic of congressional interest is both a testament to its maturity and to the willingness of this committee to strive to continue American innovational dominance. It is not lost on me the amount of work and dedication it takes to bring this many people together to constructively discuss changes that could impact the financial lives of million Americans, and I thank you. Republic was a spin-out of a prominent investment company called AngelList, with a focus on the Jobs Act as well as the Crowdfund Act. Most of this committee is no rookie when it comes to efforts to drive innovation within our beautiful country, including Congressman McHenry, who introduced the Entrepreneurship Access to Capital Act. It was from these efforts that Republic was born, a U.S.-based company that employs over 300 people, which serves U.S. retail investors, U.S. accredited investors, and institutions alike. We are a living success case from those initiatives, and we're excited to help bring the next wave of American innovation. For those who are not familiar with the Jobs Act and Crowdfund Act, they created two new regulatory securities exemptions known as Reg CF and Reg A+. These allowed for a novel framework for retail, meaning non-accredited investors, to be able to invest in companies prior to an IPO. This was a groundbreaking change from the Securities Act of 1933, and it finally gave regular citizens the ability to participate in the financial upside of early-stage companies. Regulators point to these exemptions as functional for Web3 companies to comply, but they struggle from both logistical disclosure and SEC approval standpoint. The disclosure requirements simply do not work within an industry trying to decentralize itself. On a certain, for example, once a certain number of investors or token holders are reached, the issuer is then required to register under Section 12G of the Exchange Act, inherently limiting access and inclusion from other eager participants. It's nearly impossible for a company to push towards decentralization without triggering this requirement. The second issue is the SEC approval process. Republic has attempted to register a Reg A+ security token with the SEC for the last 3 years, and after 12 turns of that document and countless legal bills, we've still been unable to get approval. In fact, the current administration has not qualified a single digital asset offering. Thus, the current system is not working as intended. Much of what this committee has discussed, and will certainly discuss today, is around crypto assets and their speculative form. But it's important to remember that what we are really discussing is a technological innovation, and one of its first use cases that has operated at scale just happens to be digital currencies. We are in the early stages of this technology, and I really want to provide some examples of that. It generally takes about 25 to 30 years for human beings to adopt a new data transfer technology. Radio was invented in 1890, but wasn't commercially available until the 1920s. TV was developed in the 1920s, but wasn't in homes until the 1950s. Email was invented in 1969, but most of you most likely didn't have an email address until 1997. There is one that I really want to focus on, and that's TCP/IP, which is the internet, for those that don't know. It was developed as a DARPA project in 1970, but it wasn't really commercially accepted until 1995 when it was rolled out with Windows 95. There's another important date, which is 1983. 1983 is when TCP/IP was accepted as the standard protocol for internet development, 13 years after it was created. Well, here we are, 13 years after Bitcoin was created, and we're just now starting to talk about standardization. This is not a coincidence. Adoption at this stage is not a technology problem, it's a human conditioning issue. Every 13-year-old in the United States has only existed in a world where Bitcoin has existed. 3 years from now, every 16-year-old will have only existed in a world where Bitcoin has existed. 16 years old is an important date because it's generally when someone becomes interested in becoming a developer. They are the adoption layer. We here in this room, we're the infrastructure layer. It's our responsibility to create an environment where every 13-year-old American has a framework upon which they can build the next world on. Thank you, and I look forward to your questions.
Thank you. The gentleman yields back. Mr. Colgan, you're now recognized for 5 minutes.
Thank you. Subcommittee Chair Johnsons and Hill, Ranking Members Lynch and Caraveo, Chair McHenry, Ranking Member Waters. My name is Matthew Culkin. I'm a partner in the Washington, D.C. office of Wilmer Hale, where I lead our law firm's Futures and Derivatives Practice Group. I previously served as the CFTC's Director of the Division of Swap Dealer and Intermediary Oversight, now known as the Market Participants Division. And I commend the subcommittees for working together today to explore potential paths forward for digital asset market regulation. These rules and policies cannot be successfully developed by any individual committee, legislative chamber, or regulatory agency. The views I shared this morning are my own. They do not represent those of my colleagues, my law firm, our clients, or any other person or organization. Thank you for inviting me to participate today. I have 3 points I'd like to make. The first is that the largest digital asset that are traded by market size and volume, those are commodities. And the statutory definition of commodity is intentionally broad. It covers almost all goods and articles, as well as services, rights, and interests in which futures trading takes place. So products like Bitcoin and Ethereum already have CFTC-registered futures contracts trading on CFTC-registered exchanges. In addition, the CFTC has successfully asserted anti-fraud and anti-manipulation jurisdiction, or its enforcement authority, over certain stablecoins, again, as defined by Congress in the Commodity Exchange Act. My second point is that the current framework limits the CFTC's enforcement authority solely to fraud and manipulation in the digital commodity spot market or cash market, and that authority is insufficient to adequately protect customers. By limiting the CFTC's oversight of commodity spot markets, market participants are not getting the benefit of basic customer protections that the CFTC could provide through registration, regulation, examination, and enforcement. And those authorities already exist in the digital commodity futures markets. I'm also talking about things like segregation of customer funds, rules governing how those funds are held in the event of a bankruptcy. And so that brings me to my third point today. Congress should expand the CFTC's role to include regulatory authority over the digital commodity spot markets. Doing so would introduce key features that are found in the futures markets, and they've worked well to protect customers for years. In addition to segregation of customer funds, I mean things like financial resource reporting requirements for intermediaries, exchanges conducting real-time surveillance over trading activity, regular examination for compliance with CFTC rules, and of course, enforcement for non-compliance with these rules. From 2017 to 2019, I had the privilege of serving as a division director at the CFTC. And put simply, I have great confidence in the CFTC's ability to carry out its mission to protect customers and promote the integrity, resilience, and vibrancy of markets. My experience has showed me how the CFTC can register, regulate, examine, and enforce. In fact, I partnered with the National Futures Association, a self-regulatory organization, on the development and implementation of a number of customer protection measures. I saw how the CFTC's enforcement program holds individuals and institutions accountable for misconduct that interferes with market integrity. Importantly, I also worked closely with my colleagues at the SEC, and I saw how the CFTC and SEC can collaborate in a productive, responsible manner. In 2010, Congress passed the Dodd-Frank Act. In that law, Congress directed the CFTC to regulate swap markets and the SEC to regulate security-based swap markets. In the years that followed, the two commissions adopted several important rules together and coordinated on the implementation of these new frameworks. There are similarities between the implementation of Dodd-Frank for over-the-counter derivatives and today's discussion regarding the regulation of digital asset markets. In both instances, there's an important leadership role for Congress. Here, Congress should make clear that the CFTC is the primary regulator for digital commodities and the SEC for securities. I believe that approach will provide these markets and market participants with a framework that respects existing laws, conventions, and market structures. Congress should build on its precedent in a manner that best protects investors and at the same time attracts and retains the innovation that has made U.S. capital markets the deepest, most transparent, and competitive in the world. I thank you for your time and be happy to answer your questions.
Thank you, sir. Mr. Santori, you're recognized for 5 minutes.
Chairman Hill, Chairman Johnson, Ranking Member Lynch, Ranking Member Caraveo, and members of the subcommittees, thank you for the opportunity to testify today. My name is Marco Santori. I'm Chief Legal Officer at Kraken Digital Asset Exchange. I was one of the first lawyers practicing in the area of digital asset regulation. I've advised clients in this ecosystem for over a decade, nearly since blockchains were invented. Today, I oversee all legal, regulatory, and policy matters impacting our global business operations. I oversee 50 lawyers and professionals around the world with deep and diverse experience and public sector and private sector backgrounds. Kraken was founded over 11 years ago. Since then, we have steadily grown into one of the world's leading global digital asset businesses. We are proud of our roots as a Bitcoin exchange, but we're equally driven by the societal and economic value that is developing well beyond financial services. Blockchains are transforming the way that we consume goods and services, secure data, and even deal in property rights. Our primary business is operating an exchange to match buyers and sellers in digital assets. Today, we serve over 10 million customers around the world through a secure and transparent centralized platform. As we've grown, our business has diversified beyond our exchange. We operate the world's leading digital asset index provider, which serves some of the largest futures exchanges and asset managers here in the United States. We offer staking and futures trading in eligible jurisdictions, and we have founded a first-of-its-kind state-chartered special purpose depository institution called Kraken Bank. Today, our global team of over 2,000 professionals is located in the U.S. and across more than 70 countries. We collaborate and advance our mission through contributions from many geographies, professional backgrounds, cultures, ethnicities, and of course, political viewpoints. The diversity of our team is a competitive strength. It aligns our business with the global nature of our markets and the dynamic community of customers and innovators we serve. Security and customer asset protection has been central to our culture and our business model from our inception. We hold regulatory licenses here in the United States and around the world, including the United Kingdom, the European Union, Canada, and other developed and emerging markets. My team and I are thrilled to operate with a global perspective because many countries are advancing effective, practical, fit-for-purpose rules governing digital asset participants. Europe and the United Kingdom, for example, have focused on assessing the specific, real-world characteristics of digital assets and advancing risk-based rules to regulate them. Although approaches differ by jurisdiction, there is a common thread through these efforts. Instead of forcing new products into old regulatory schemes, they craft more effective rules from tested principles. In the United States, however, we face significant regulatory gaps. Those gaps are so stark that they have spawned seemingly an unending docket of both private and public litigation. This litigation has not protected consumers. This litigation will not protect consumers either. Congress can fill these gaps with clear mandates. First, a functional standard and process for drawing clear jurisdictional lines for SEC and CFTC oversight. Second, a workable registration path for exchanges at each agency. Third, clarification of the role of the CFTC over spot markets. Fourth, clear direction for ongoing regulatory cooperation. And finally, workable transitional arrangements to avoid market disruption until then. Congress, led by these subcommittees, can fill these gaps to improve markets, empower consumers, and ensure the United States participates in the world's next wave of technological innovation. As you've heard from other witnesses today, there is clear precedent for Congress here. Following the 2008 financial crisis, Congress passed Dodd-Frank, which set up lines of demarcation and joint supervision of swaps markets for both the CFTC and the SEC. Today's collaboration across committee members and staff and across party lines demonstrates both the willingness and the ability for Congress to get this right. I look forward to your questions and our discussion. Thank you.
Thank you. Mr. Schoenberger, you're recognized for 5 minutes.
Chairman McHenry, Chairman Thompson, Chairman Hill, Chairman Johnson, and Ranking Member Waters, Ranking Member Scott, Ranking Member Lynch, Ranking Member Caraveo, and other members of the committees. On behalf of the Web3 Foundation and the Polkadot ecosystem, I would like to thank you for the opportunity to testify today regarding blockchain technology and the benefits of Web3. I am Daniel Schönberger, the Chief Legal Officer at the Web3 Foundation, and I've worked at the intersection of emerging technologies, law, ethics, and public policy for more than 20 years. The Web3 Foundation was formed with the goal of establishing Web3, a new and better internet infrastructure. It wasn't about building a currency like Bitcoin or a smart contract platform like Ethereum. It was about giving siloed blockchains the ability to communicate with each other, and to realize this vision, the Polkadot network was built. Now think of Polkadot as the SMTP protocol of the internet used to send and receive email, and think of layer 1 blockchains such as Bitcoin or Ethereum as email providers like Yahoo or Google. Polkadot allows these distinct programs to communicate with a seamless connection and interoperability. Without this infrastructure, this would not be possible. The native token of the Polkadot network is a blockchain-based token known as DOT, D-O-T that is. It should be thought of as the orchestrating tool used to secure and govern Polkadot. To facilitate the creation of this ecosystem, a future DOT token was sold in private sales from 2017 to 2019. The foundation treated DOT as a security in accordance with Regulation S&D, and the foundation confirmed the identity of the original buyers through KYC and AML checks. After 3 years of engagement with SEC staff, the foundation believes DOT is no longer security based on the Howey test. DOT also satisfies the factors indicating a token is less likely to be a security as set out in the framework for investment contract analysis of digital assets, as it was issued by the SEC Strategic Hub for Innovation in Financial Technology, FinHub. Given DOT's functionalities and properties, the foundation thinks of DOT as merely coordinating software. The foundation suggests putting DOT in a separate category, for example, a class of utility tokens. The most important regulatory concern for the foundation is the classification of tokens. Both Switzerland and the European Union have created a clear framework distinguishing between payment tokens, security tokens, and utility tokens. Under the current US regulatory approach, a token is forced to fit into limited categories. However, it is not always clear in which category a token should be placed. As a simple example, the chair I'm sitting in could be tokenized. Also, there will be some tokens that will have the characteristics of a particular asset class, and at a time in the future will cease to have those characteristics. This is part of the nature and innovation of blockchain technology. Clearly, a legislative process to re-evaluate a token is necessary. The SEC staff has already outlined a path to evaluate the status of a digital token. The foundation suggests that Congress establish a procedure through legislation to authorize regulators to re-evaluate the status of tokens. And let me be very clear. If a token is used for fundraising purposes, it should be subject to all applicable laws and regulations. However, that same token may serve a functional purpose devoid of speculative investment in the future. We fully support putting into place a legally binding process of token reclassification. And we applaud the subcommittees for undertaking the hard work and deliberation necessary to develop a legislative framework. We would ask you do so with the understanding an approach that recognizes new technologies. To simply apply existing regulation would be inadequate to truly address this emerging technology. We look forward to helping the committees develop a comprehensive framework for all token classification in the US, and are confident that with clear statutory guidelines, the US will continue to lead the world in innovation. I look forward to answering your questions. Thank you very much.
Thank you. Mr. Massett, you are recognized for 5 minutes.
Thank you. Chairman McHenry and Thompson, Subcommittee Chairman Hill and Johnson, Ranking Members Lynch and Caraveo, members of the committees and staff, I'm honored to be testifying before you today. You know, since 2014, when I became chairman of the CFTC, I've talked about the gap in crypto regulation, and you've heard a lot about it today. Obviously, we don't have a federal regulator of the spot market in tokens that are not securities, and we have this classification debate, which makes that gap worse. So the question is, how do we fix it? And there are now lots of calls for maybe tinkering with securities laws definitions, coming up with a new category, coupling that with giving jurisdiction to the CFTC. The part that concerns me is that rewriting of the securities laws and creating that new definition, because I think it is likely to generate its own questions of interpretation that may lead to lots of litigation and confusion. I think it may also create unintended loopholes. And frankly, we don't have the information today to know how to classify tokens, to apply the Howey test. So I think there's another approach, and which is that we would pass a law that requires that any trading platform or lending platform that uses or trades Bitcoin or Ethereum has to comply with a set of principles for everything it does, for all the tokens on the platform, for all of its activity. And those principles would be the ones we're all familiar with: protecting customer assets, preventing fraud and manipulation, requiring risk management, requiring reporting, requiring trade transparency, preventing conflicts of interest, and so forth. Congress would direct the SEC and the CFTC to develop joint rules implementing those standards, or create an SRO that would develop those rules and implement and enforce them. So I think there's several advantages to this. One is it's simple. The law would give us jurisdiction over all of those platforms that are important, because no platform can exist without trading Bitcoin or Ethereum, without having to rewrite the securities laws, number one. And the principles would, as I say, apply to all activity on those platforms. Second, it focuses on the core of the problem. Over 90% of the spot market trading occurs on centralized intermediaries. Simply eliminating wash trading on those platforms would be a big improvement. Third, it is practical. It would not require bifurcation of the existing market into one platform for trading commodity tokens and one platform for trading security tokens, which is helpful not to do that, because crypto trading actually occurs in pairs today. In addition, by using an SRO, we would be able to require the industry to pay a lot of the cost and thereby reduce the federal budget impact. As I say, the approach would not involve rewriting securities or commodities laws. The SEC and the CFTC would retain their existing authority, and the SEC could still bring a case claiming that a particular token is a security. But if it prevails, the platform would simply have to stop trading that token or move it to a registered platform. The SEC would not be able to shut down the platform as long as it was operating in compliance with these core principles. So that assures that the platforms can continue on a more responsible basis while these classification issues are resolved. It would also, as I say, provide for some disclosure, which is important for investor protection and to enable us to decide how to classify things. It's an incremental approach. I think we can build on it. It's also a solution that I think can be bipartisan. Former SEC Chair Jay Clayton, appointed by President Trump, and I have kind of formulated this. I know he supports it. We also think it's a proposal that people can support regardless of how you value the importance of crypto. If you're a crypto enthusiast or a crypto skeptic, we don't have to debate that. Let's just put in place a framework that provides investor protection, lets us move forward, and we can always come back and do more. Finally, let me say there are other gaps in the law, such as on stablecoin regulation. I appreciate the efforts of these committees on that, and happy to talk about that as well. Thank you.
Thank you very much. Mr. Blaugrund, you're recognized for 5 minutes.
Subcommittee Chairs Hill and Johnson, Ranking Members Lynch and Caraveo, Chairs McHenry and Thompson, Ranking Members Waters and Scott, and distinguished members of the subcommittees, thank you for the opportunity to testify today on the regulatory future of digital asset markets. My name is Michael Blaugrund, and I'm the Chief Operating Officer of the New York Stock Exchange. National securities exchanges, such as the NYSE, serve a fundamental role in the capital markets ecosystem by providing a forum for companies to raise money, as well as a venue for investors to buy and sell the securities of public companies at transparent prices in a fair and orderly manner. Next week, the NYSE will celebrate the 231st anniversary of the signing of the Buttonwood Agreement, the foundational document that established our exchange. For more than 2 centuries since, we've worked to establish and maintain the United States' position as the envy of global capital markets. In advancing this position, we focus on utilizing innovative technology to enhance our nation's vibrant markets and remain competitive around the world. I'm here today to share some perspective from our experience. Although technology evolves over time, the obligation to protect investors does not. Whether trading occurs via open outcry, over telegraph, through pneumatic tubes, or pursuant to complex algorithms, the public rightfully expects that their assets will be protected from fraud, theft, and manipulation. The regulatory framework governing national securities exchanges brings transparency and a trusted environment for issuers and investors. As investors increasingly seek exposure to digital assets, it's never been more important to develop a regulatory framework around them that protects the public. This is not unlike the problem that Congress faced nearly 100 years ago that led to the establishment of the Securities and Exchange Act to address these same policy objectives. So, how best to protect public investors who seek to engage in the digital assets market? The lesson to be drawn from the more established markets is clear. The segregation of key functions within the financial markets ecosystem, brokerage, exchange, clearing, and custody, mitigates inherent conflicts of interest, promotes transparency, and facilitates competition among service providers. This, in turn, benefits investors and results in a more fair, efficient, and safe environment. When investors trade on the New York Stock Exchange, they're represented by registered broker-dealers, whose trades are cleared and settled by registered clearinghouses, and whose assets are held by registered bankruptcy-remote custodians. Investors have recourse if they're harmed by any of their service providers, and multilateral clearing reduces counterparty risk. By comparison, some current-day digital asset trading models, as witnessed with the collapse of FTX, commingle the functions in a way that raises serious questions of risk management, financial resources, and investor protection. We believe that if investors could trade digital assets in a similarly regulated exchange environment, many of the problems we have seen in the last year would not have occurred. Competition among securities and commodities exchanges is fierce, and new entrants are a regular occurrence. There's a well-established process to launch a registered exchange, whether one with a unique listing concept, a unique trading protocol, unique operational features, or a unique market segment. To date, however, we've not seen a digital asset trading platform follow this well-worn path. There's a dissonance between much of the current digital asset industry's practice and the standards of investor protection established under the law and regulation for traditional markets. Some have argued that the rules and regulations should be relaxed to accommodate current crypto practice, while others have asserted that the market for digital assets must adapt to existing standards. Congress can determine its preferred course of action. It's our belief, however, that the exchange regulatory framework represents an established and well-known foundation that can be adjusted to accommodate the marketplace for digital assets. In this regard, there are several steps that can be taken by government agencies that would facilitate practical oversight for digital assets. First, provide a tailored registration process for investment contract tokens. Second, replace the temporary SEC conditions for special purpose broker-dealers to custody digital assets with a more permanent solution. Third, permit adjustment to applicable rules of national securities exchanges and clearinghouses to support securities or other digital assets that are not considered national market system securities. And fourth, evaluate the potential for dual registration or substituted compliance between SEC and CFTC regimes. Coordination between the two agencies would work to mitigate the costs, burdens, and uncertainty that can arise when more than one regulatory regime is implicated. American capital markets have long benefited from evolving within the parameters of well-established rules. Our experience over the past 231 years is a testament to the ability of market participants to promote investor protections while adapting to technological innovation. Thank you, and look forward to your questions.
We appreciate our panel's testimony. We'll now turn to our member questions. I recognize the chairman of the Subcommittee on Commodity Markets, Digital Assets, and Rural Development, Mr. Johnson, for 5 minutes.
I know this town loves kicking the can down the path, but there are times where it's just clear, even to Congress, that action is appropriate and needed. Mr. Durgee, I was so grateful for you to point out that a 13-year-old has only grown up in the Bitcoin era. We've learned a lot during that time, and in fact, every single witness that we have today, and every single witness we've had before our subcommittee on digital assets, have all said that there is a lack of clarity within existing law that is holding back innovation in the marketplace. It is holding back America's ability to be competitive in this development space, and it is not properly protecting consumers in the broader marketplace. And so we get to a point where we know that action is appropriate. I think the contours of what that looks like are beginning to come into focus, thank goodness. But I want to hone in on one of these central questions, and I'll come to you, Mr. Culkin. We know that the Howey test, one of the legs of the Howey test, is about whether or not a centralized group of decision makers have a substantial impact on the value of that thing. If they do, it's highly likely to be a security. In Mr. Schoenberger's testimony, he talked through the multi-year process that Polkadot went to be more decentralized. Why is that an important characteristic of when something can go from being a security to becoming a commodity?
So, Chairman Johnson, thank you for the question. You know, the Howey test really looks at the issue or sale of a security. So you're thinking about it at the moment that the product is put out for investors. You know, I would distinguish that, as some of my panelists described, I would distinguish that from trading down the road after it's been put out, where you don't necessarily have the expectation of profits based on the efforts of others, and it becomes more fungible, or I might even say more commoditized. And then the trading in that market, in the secondary market, it looks a lot more like a commodity as defined by Congress.
And so as we're looking to try to help guide the SEC and the CFTC as they try to determine how to apply something like the Howey test to this question of decentralization, are there particular factors we should look toward? Are there particular triggers? Well, when do we know that it's substantial, that it's sufficiently commoditized?
Well, for starters, we can look at where derivatives markets already exist. So if there are futures contracts that have been certified by exchanges at the CFTC, and we have people hedging risk on the commodity, that's a pretty good indicator something's been commoditized. The other way to look at it is to look at the action of the commissions as a body, as opposed to any individual chair or commissioner or a speech or a staff statement. In this case, we've seen the CFTC as a body take action against certain stable coins in the spot market where they've identified fraud or manipulation that has impacted others. And so, you know, I look at sort of those sources first to determine whether or not something is a commodity.
Yeah, it seems that doesn't, I mean, looking to the regulators for an environment that seemingly everybody acknowledges doesn't have proper clarity for the regulators or the marketplace, it seems like we could help them better ascertain when does that trigger hit. We're not providing a lot of guidance. Is there anything else you could say to help us find a way forward?
No, I think that inflection point, it's a challenging one, I'll admit that. And so, you know, it's sort of easy to draw out the two ends of the spectrum in terms of a token being offered to raise capital versus something that's highly commoditized and hedged in the derivatives markets. That point in between is a challenging one to draw a very bright line.
Well, as you noted in your testimony, 71% of the market capitalization in this area are products that it seems like there's broad agreement that they are commodities. So the CFTC is generally the cop on this beat, but for spot market, you noted in your testimony that you're not suggesting the CFTC should have broad spot market enforcement authority everywhere, but just looking at digital assets because they're different. How are they different?
So they're different in a couple ways, and if I could, Ranking Member Caraveo pointed this out at the last subcommittee hearing. Many of these digital commodities have a very strong retail component, and so that is different than soybeans or oil or interest rates. We have a very strong retail market here that needs the benefits of customer protection. The other reason is that it's new, and so the other commodities that I just used as an example, they have years or decades or generations of existing spot market regulation, whereas digital commodities do not.
Thank you, sir.
Thank you very much. gentleman yields back. I recognize the ranking member of the Subcommittee on Commodity Markets, Digital Assets, and Rural Development, Ms. Caravello, for 5 minutes.
Thank you, Mr. Chair, and thank you again to our panel for being here this morning and for your testimony. A common argument, which I touched upon in my testimony, is a concern that the CFTC's relative size compared to other federal financial regulators and the impact that may have on the ability of the Commission to engage in robust enforcement. So, Mr. Massad, you were the chair of the CFTC at a time when the agency was implementing Dodd-Frank, which provided the Commission with additional regulatory authority over the swap market. Were there similar concerns at that time for the CFTC's ability to oversee those swap markets?
Absolutely. It's not possible for the CFTC, or frankly any agency, to suddenly take on a whole new area of jurisdiction without additional resources. In the case of the swap market, we did the best we could, but we were cutting a lot of other activities that we should have been, I think, spending more on. Oversight of a lot of the existing market, the existing infrastructure. You know, it's as if you all decided, you know what, let's have the Capitol Police not just do the Capitol, but all the airports around Washington, but let's not give them any more resources. It just doesn't work.
Thank you. I think that's an important an issue to point out, especially as we're facing potential cuts across the board to many agencies. To follow up, I also just briefly wanted to touch on the theme of today's hearing, which is cross-jurisdictional cooperation and collaboration. Sir, for you again, what are some measures that can be taken to ensure that the CFTC, the SEC, and Treasury, and other financial regulators work cooperatively to further industry compliance?
Excellent question, Congressman. Again, I think the approach I've suggested, Congress would effectively require it. Congress would effectively say the CFTC and the SEC have to come up with some joint rules or create the SRO to do it, give them a deadline, and that would basically, you know, force the agencies to do it. I think, again, that's a better approach than trying to rewrite the securities laws to create this new definition. And, you know, I would take issue with a lot of the comments that have been made that, you know, about the indicators. I mean, there's a comment earlier about the fact that, you know, something is commoditized means it's not a security. No, it doesn't. I mean, you can have a futures contract on something that's therefore a commodity, but it's still a security. You know, Tether, we have futures contracts on Tether. That makes it a commodity. Now, most of us may not think Tether is a security because it doesn't pay interest. We'd like to see it regulated as a banking product. If it suddenly paid interest, it would be a security. There's a group of people running Tether and profiting from Tether. But the fact that those futures contracts are traded on Tether doesn't remove it from being a security.
Thank you. I appreciate those comments, and I yield back, Mr. Chairman.
Thank the gentlewoman from Colorado. I recognize myself for 5 minutes for questions. Appreciate, again, the panel, and I really appreciate Mr. Durgee commenting about the progression of technology and its adaptation by the American people. I thought that was good perspective because sometimes we're lost in this debate here about blockchain and distributed ledger technology. We forget that it is a technology and we're off chasing the rabbit of a particular digital asset or commodity. And I think you make a good point. And I remind my colleagues that in 1996, the Congress, under the leadership of former SEC Chair, then Congressman Chris Cox, passed a resolution that said we're not going to tax the internet. We're not going to over-regulate the internet. We're going to let this technology progress, and we're going to tax and regulate and consider things on what people do with the internet as a technology. And I think that has created 25 years of amazing economic growth as a result of that forward-thinking consideration. So I think that's the spirit in which we work today. The SEC disclosure regime is designed to provide reasonable investors with information needed to make informed investment decisions. Thus, if the existing disclosure regime for digital assets isn't producing that kind of result, then the ultimate purpose of the U.S. securities laws is in fact not being met from an investor protection capital formation point of view. Current disclosure requirements, however, do not cover a number of the features unique to digital assets that would undoubtedly be considered important to any potential purchaser. Mr. Santori, what are some of the features of digital assets that are not contemplated in the existing securities disclosure regime?
Thank you for the question, Chairman. First of all, we agree that the existing disclosure regime does not contemplate most of the characteristics of digital assets that make them rewarding for users, but they also don't they also don't account for the characteristics of digital assets that can make them risky for users, and that is where the primary gaps exist today. Some of the elements of digital assets that users want to know about, and indeed the people in this room are likely to ask about if they were to ever use digital assets, include the number of nodes operating on the network, how many developers are actually developing on this network, whether these developers are associated or whether they are operating independently, where those nodes operate from. These are highly technical and digital asset specific characteristics that frankly I could probably list for well in excess of my time or your time, Chairman Hill. I
think it'd be useful if you just expanded on that in writing and just talk about those specific disclosure gaps. I think that would be helpful to me. Mr. Culkin, to the extent to which a digital asset project is sufficiently decentralized, there's not an issuer disclose this info, such as Bitcoin or Ether. So how could an intermediary provide disclosure to investors?
So Chairman Hill, there's a couple pieces to that answer. First, for the intermediary, there can be disclosure to the customer about how the intermediary conducts its business. And on the product side, and I look at the CFTC's model for futures and swaps right now, where an exchange needs to certify the product to the CFTC, provide commercial details about the product, explain how it's not readily susceptible to manipulation, how the financial integrity of the product is protected. There's a model there that can be used, but maybe at its core, disclosure is only as good as it is accurate. And so it's got to be policed for fraud.
Well, in this regard, SEC Commissioner Peirce proposed a disclosure framework in her safe harbor proposal that would have accounted for some of these differences. The framework would include disclosures related to source code, token supply, governance mechanisms, and other aspects unique to digital assets. Mr. Santori, do you think Commissioner Peirce's approach would be a workable one based on our conversation?
Thank you for the question, Mr. Hill. I do. I think Commissioner Peirce's approach is thoughtful. It is well tailored to the risks and the rewards. I think that Congress has tremendous discretion in this regard, but Commissioner Peirce's proposal would be light years ahead of what we have today in terms of protecting consumers and allowing us, as a global business, to continue to plan to invest here in the United States.
Thank you. And I think an important concept, Mr. Schornberger, that you raised was token reclassification. And I think that's at the heart of this issue, no matter whether you're taking Tim's approach or somebody else's approach. And I think if each of you would submit for the record your ideas on how one thinks about that idea of token reclassification, that would be helpful. With that, I yield back. The ranking member of Digital Assets Financial Technology, Mr. Lynch, for 5 minutes.
Thank you, Mr. Chairman. Mr. Massard and Mr. Blaugrund, I was heartened by your testimony, and I offer my cooperation, Mr. Massard, with some of the ideas you've talked about with former Chair Clayton, and love to be part of that conversation. So the U.S. financial system is indeed, as a number of you have said, is the envy of the world and a source of strength, not only economically, but in international relations and in the geopolitical sphere. But it is built on trust, right? It's built on trust at its very core. And every time a crypto firm explodes, whether that's FTX or Terra or Voyager Digital or Genesis or Silvergate, which is a crypto bank, and as a result of those explosions, investors get locked out, and now we have millions and millions of investors who are trying to get their money back, unsuccessfully so far. We lose trust. We lose trust in that in that system. And we also know full well that criminal enterprises, it's a favorite tool of some of these hacking episodes that we see criminal entities, foreign and domestic, actually capitalizing on the anonymity there and using that to further their criminal enterprise. So you've got all that going on, and now we have an effort by some to import all of that instability, all of that risk, all of that volatility into the previously stable financial system. And as my colleagues, Ms. Caraveo has pointed out, there's a suggestion that, well, we'll move this over to the CFTC, which has about 600 employees. Take it away from the SEC that has about 4,500 employees and has a hard time keeping up. So, Mr. Massad, what are some of the, you've talked about it a little bit in your opening statement, but what are some of the measures that would be necessary if we were going to try to share jurisdiction here or shift those responsibilities over to the CFTC? And just as a heads up, Mr. Blaugrund, I want to ask you, the same question with respect to the SEC and what that would involve and what gaps you see in that exercise. But Mr. Massad, go ahead.
Thank you. Thank you, Congressman. Well, obviously, resources. You cannot expect, frankly, either agency to really tackle this market in a much more substantial way, in the way that we need, given the lack of investor protection. Without significant resources, it would be very, very significant in the case of the CFTC. I often said to Chair Benham when he was suggesting they get spot market authority, I said, be careful what you wish for. But secondly, I think it still goes to this question of what exactly would they be getting jurisdiction over? And that's where, again, I would rather see a system where we force the two agencies to work together, to work through an SRO, and that way the industry could basically have to pay for it.
Can I ask you on that, on a self-regulatory organization, are there examples out there that you think would offer instruction?
Sure. I mean, first of all, by self-regulatory organization, I mean something that is closely supervised by the agencies. It doesn't simply go off on its own, like FINRA, like the NFA. We do have a precedent for jointly recognizing those SROs. And so what I'm suggesting is sort of going the next step where we say, all right, we're going to have a joint one that is mandated to do this common task, if you will, and develop rules that would then have to be approved by both agencies. But again, I think it's a good interim step forward. It would allow us to bring this sector within regulation, which I think is better than pushing it out.
I want to let Mr. Blaugrund get in on this a little bit from the FCC perspective.
Thank you. I would agree that finding a path forward that in some respect renders moot the question of whether a token belongs on one side of a perimeter or the other seems like a sensible path. With respect to the process of doing that, we think potentially dual registration of exchanges or broker-dealers that would allow for example, a national securities exchange that decides to trade digital assets to also trade Bitcoin and ETH, if those are determined not to be securities, would be essential, as those are, as was noted, the lion's share of the market activity today.
Thank you, Mr. Chairman. I appreciate your courtesy, and I yield back.
The gentleman yields back. I now recognize the chairman of the full committee on agriculture, Mr. Thompson, for 5 minutes.
Well, Chairman, thank you so much, and thank you to each of the witnesses for being here for this joint hearing. I want to echo my fellow colleagues' comments and thank our members and witnesses for being here today. When Chairman McHenry and I first met to discuss the digital assets framework, we set our eyes to a bold plan. We sought to put forward the best policies we could by developing together. While both our committees have been considering digital assets for several years, over the past few months, members of both committees have engaged in robust and collaborative debate and education on the current securities and commodities laws and regulations. This joint hearing is a culmination of those events, which have shed light on a couple of key points, including the current process to determine if a digital asset is a security or not is unclear, unworkable, and impractical. The CFTC lacks the essential regulatory authority over retail serving intermediaries in the digital commodity spot markets, and the treatment of customer assets held by intermediaries needs to be strengthened. I'm proud of the thoughtful approach that members of the Agriculture Committee have taken to considering these questions thus far, and I look forward to the work ahead with our financial services partners. It is that thoughtful curiosity that makes for the best regulation in the end. And I hope we're able to work together in a bipartisan manner on a substantive legislation to address the issues that are being discussed today. Now, our committees have a historic opportunity to work together to create a comprehensive digital assets market framework that will provide a pathway for developers and users to engage with digital assets in a safe, compliant, and quite frankly, productive manner. So my first question I have is Mr. Culkin, for Mr. Culkin. Mr. Culkin, Mr. Massaud suggests that the CFTC and SEC should establish a joint self-regulatory organization, SRO, to regulate pursuant to core principles established by Congress. Do you think a CFTC-SEC joint SRO construct is an efficient, effective, and a practical solution?
So thank you for the question, Mr. Chairman. I agree with a lot of the diagnosis that Mr. Massad has offered. I worry that creating a new SRO from scratch would take time. I don't know. I think about this in terms of incremental progress, and I don't know that we need to recreate the wheel here. And so I noted in my opening statement that more than 70% of digital commodities currently being traded are commodities. And so by expanding the CFTC's authority beyond just enforcement authority, which is reactionary, to regulatory authority and requiring those exchanges, those intermediaries, to be registered, regulated, examined, and then subject to enforcement, that's probably a quicker path to providing the investor protections that are currently lacking in these markets.
Could you please tell me about past instances where the CFTC and the SEC has shared jurisdiction and whether there are any lessons learned from those experiences?
Sure. So I think the biggest success case is post-Dodd-Frank, when the SEC was given jurisdiction or asserted jurisdiction over security-based swaps, the CFTC over swaps. And through that, the SEC and the CFTC adopted joint rules together that really set the fundamental baseline for swap market regulation. I think that succeeded because Congress led and gave direction. And I would contrast that with the work that's been done on security futures contracts and securities future regulation, where the agencies work together, but not with the same direct clarity from Congress, and it hasn't been as successful.
Mr. Massaud cites the National Futures Association as precedent for this construct. Are you familiar with NFA's role as a joint CFTC-SEC SRO? Well, we'll start with Mr. Culkin, if we could.
Yes, Chairman. So when I was at the CFTC, part of my portfolio included working with NFAs. So I think it's important to note, NFA has 500 employees. Post-Dodd-Frank, they built out from scratch a complete registration and examination program for swap dealers. And we're a decade out now, and it's fully operational. And so when I think about an SRO model, we've seen in recent years NFA do exactly what we're talking about today.
Very good. Just a few remaining seconds. I want to thank our two subcommittee chairs for doing such a great job in this space. Appreciate your leadership. I yield.
Thank you. The chairman yields back, and now I have the pleasure of recognizing my friend from Georgia, the ranking member of the full Committee on Agriculture, Mr. Scott, for 5 minutes.
Thank you. Am I on? Yes. Okay. Thank you very much, and I want to thank all the witnesses for joining us. and being here. This is a very important and timely hearing. As some of you may know, I have long been concerned about the risks and the pitfalls of cryptocurrencies and what they pose for our retail investors. And also, as some of you may know, as chairman of the House Agriculture Committee, I provided leadership on this issue 1 year ago. On May 13th, 2022, we held a hearing examining fintechs and its proposal to trade margin products through a non-intermediary model. And in that historic and monumental hearing in our House Agriculture Committee, I raised my serious concerns about this proposal because I believed it made an already risky market even riskier for investors. I was concerned that FTX was playing fast and loose with our markets to the detriment of the customer, and I have been proven right. And I continue to be concerned, as are now many other members of Congress who have followed my leadership on this issue, about the vulnerability and the volatility of cryptocurrency, which we have seen time and time again. And now, FTX's stunning collapse has revealed extraordinary mismanagement, misappropriations of customer funds, a complete failure to adhere to basic measures of corporate control, and quite honestly, an arrogant example of corporate deceit. And FTX, while certainly the most prominent example, is not alone. BenNex Holdings is currently under investigation for violations of our sanction laws. And we have seen countless other examples of this type of misuse and abuse. So, ladies and gentlemen, as we have seen time and time again, these sketchy types of offerings provide little to nothing in the way of disclosures to investors who, quite honestly, are being used. And now, ladies and gentlemen, our cryptocurrency markets are rife with fraud, misuse, and volatility that seem to pose all risk and no reward for our everyday investors. So here's my real point. This supposed benefits of digital assets that we have all heard about have yet to be seen in real life. It doesn't work as a currency. And I ask you, do everyday Americans pay for goods and services using cryptocurrency? The answer is absolutely not. And importantly, it does not advance economic inclusion. And as so many platforms claim they do. Ladies and gentlemen, I have spent 20 years as a member of the United States Congress fighting for true financial inclusion. And that means ensuring that consumers are protected from fraud, are protected from scams, and are not subject to hefty fees for their transactions. Also, it means improving the overall financial health of all consumers, especially low-income consumers who are unfortunately regularly left out of our financial system. So let me ask you, how does pushing these same consumers into opaque, risky, volatile markets advance these goals?
Would you please?
There's no way they do. So,
Mr.
Chairman
Scott?
Massad.
Mr.
yes.
Scott, I would like to ask you to direct that question to somebody to respond in writing because your time's expired.
All right. Please, Mr. Massad, respond to in writing.
Gentleman yields back, and now call on the gentleman who is the chairman of the Housing Subcommittee and Insurance for Mr. Davidson for 5 minutes.
I thank the chairman. I think our witnesses, and I think in spite of all the narratives up here, the market's really clear. I think of any number of companies that have experienced, Gary Gensler's Hotel California approach to crypto regulation, where there's no path to leave. You come in and you ask for the clarity that he says is there, and there's just no path to escape. Several of the companies who have witnesses here today have experienced that, and you're like, oh, if I only knew to click the link to file, I think the Kraken CEO said, we could have saved millions of dollars. The reality is not shaped by what the members of Congress are saying up here. The market is very clearly speaking, and we do need to react to that. So, Mr. Santori, in a Politico interview you gave last month, you were asked what you believe is an underrated idea in this space. You said that it was the power of exit, and explain how we don't have such an ability to exit from intermediaries in traditional finance. This would be the ability to have self-custody. So in your testimony, you also explain how your exchange complies with Know Your Customer and anti-money laundering laws. Can you explain for some of these members of the two committees how it's possible to reconcile the idea of self-custody while simultaneously adhering to Know Your Customer rules?
Thank you for the question, Congressman. I do think the two are compatible. I think that we as an ecosystem can both walk and chew gum at the same time. I think that KYC is not incompatible with self-custody. I think that the important factor is who is best placed to collect that information. Kraken is a centralized service. We are a custodian. We are an intermediary. We are here today to reinforce that we are indeed well placed to collect that information. We KYC every single customer that uses our platform in the United States, from South China to South America to the South Bronx. We KYC everybody because we are well placed to do that. But part of the promise of digital assets is the ability to self-custody. We don't offer self-custody products, but other participants in the market do offer self-custody products. Those are pure software, that is pure speech. They are publishers of software. They are not in a position to collect KYC information, and they shouldn't be required to. We don't require KYC for every single transaction in the U.S. economy. It doesn't make sense to require every participant in the U.S. economy to KYC. We, as a centralized exchange, are happy to do that, and we would expect that that be included in any action that Congress takes as a result of these hearings.
Yeah, thank you for the clarification. And I think custody is just so important. Of course, self-custody is just the ability to own private property. And I think it's also important that we recognize when are capital gains, if any, triggered, and it shouldn't trigger whether you move from one custodian to another, including self-custody. So, Mr. Schoenberger, in your testimony, you mentioned that Polkadot is ranked as a top industry participant when it comes to your protocol's level of decentralization. In my bill, the Token Taxonomy Act, one of the bright line elements I propose for defining whether a digital asset is a security or not is the degree of control that an issuer would have over the digital asset. So when this body writes laws that will help distinguish between what is and is not a security, do you believe that we should factor in the level of decentralization that protocol has, like proof of stake?
I very much think so, that this is a crucial point, because community consensus, which goes back to decentralization, is at the core of the idea of Web3. And if we look at the DOT token, what it does, it's essentially a piece of orchestrating software. It's technology. It's a piece that helps access and participate in the broader network bit. And I think we should look at what these tokens do if we want to regulate them, as opposed to like what they're called. And the foundation launched the network and gradually gave up control. Like that was a launch process that lasted a year and a half, but ultimately seized central control, be it at the technical or a governance level.
Yeah, I think that's an important distinction. And how do we measure when that point occurs? I think of Protocol Labs and Filecoin in a similar path where they very overtly used our existing framework to launch the project. But at some point, this is the Hotel California they can't escape from. When is Filecoin actually a digital asset and no longer part of the entity Protocol Labs? I hope we resolve that here today, and I yield back.
I thank the Vice Chairman of the committee for yielding back and turn to my friend from Illinois, Dr. Foster, for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. Estimates that were referenced in the testimony indicate that anywhere between 50% and 95% of Bitcoin transactions are fakes, that is, wash trades and similar frauds on the market. So for the first question, does anyone on the panel believe that it is possible to conduct a well-regulated futures or derivatives market when the underlying asset is subject to this level of market manipulation? Let the record show that no one believed it was possible.
Sir, you have two people with their lights on. I think.
Is that right? Okay,
Well,
yes.
well, Congressman,
Also describe how you can have a well-regulated derivatives market when the underlying asset is subject to massive market manipulation.
Well, I think that question supports why the CFTC, which is limited right now to simply monitor
the spot
fraud.
market, right? Yeah,
That's right. And
I agree completely. That's the point. You agree with the point that we've got to do a better job. We have to eliminate manipulation in the spot market to have a well-regulated derivatives.
Yes.
Okay. So everyone concurs with that. Great. Now, if we wish to prevent wash trades, insider trading, front-running, money laundering, ransomware, and everything else, is there any alternative to having both sides of every crypto transaction associated with a traceable digital identity, and have that digital identity issued by a government with which we have extradition treaties and a common concept of financial fraud? Is there any alternative to that? All right, let the record show that no one came forth with an alternative.
Sir, are you asking whether there is an alternative to a digital identity
How do you
issued by a
prevent wash
government?
trades without associating both participants in any crypto transaction with a trusted, traceable digital identity?
I do believe there are alternatives to that. I believe the alternatives are numerous.
Do you describe one example of something that can prevent wash trades that does not have traceability of digital identity to both participants?
Kraken, for example, monitors our exchange for abuse and market
on your
manipulation.
exchange, but you accept Bitcoin, which gets traded anonymously on the dark web without that. So you're basically a portal to that. You can't, you're not preventing.
I wouldn't say that at all. I think we play an important role as gatekeepers in this industry.
But there are wash trades happening with self-custody that you cannot control, for example.
I would be surprised if wash trades happened in any meaningful sense. Trades cost. They are expensive to do on-chain, and particularly in mass. Wash trading on-chain is regularly detected by forensics platforms. There are vendors.
For some crypto assets, there are crypto assets where the identity is much more difficult to trace, and I believe this is not possible, and the market will no doubt move to those if it is driven by the desire to do anonymous and fraudulent trading. So I think that really, to my mind, the place that we have to go, well, actually, Mr. Culkin, you mentioned on page 9 of your testimony that various industry participants have suggested that various KYC solutions, including even at the wallet level. And so this strikes me as where we're going to have to end up here. Now, if you just look at the automobile industry and how essential it has been to the correct and the development of the automobile industry to have license plates mandatory on every car and have the license plate issued by a registered driver. That it would be completely unacceptable to have unlicensed cars with unlicensed drivers cruising through your neighborhood or coming across your international borders. And so for the same reason, I believe we will have to issue a trusted digital identity associated with every, at the wallet level. Every crypto wallet, you'll have to say, I want a wallet, go to a government that we trust, and have that wallet, the license plate issued for that wallet. So that's personally, is there, could you describe some of the proposals, concrete proposals for wallet level identity?
So Congressman, I'll defer to others. I think someone else on the panel made the point about KYCing wallets, but I would, to build on Mr. Santori's point, note that if the CFTC had regulatory authority over the spot market, it would be able to impose on registrants through core principles in the same way that it does for futures and swaps markets, that the exchanges conduct surveillance, that they KYC participants as part of their onboarding, that they submit to the rules and jurisdiction of the exchange, and those exchanges essentially act as an SRO in addition to the CFTC and NFA.
Okay, Mr. Schoenberger, in your testimony, you made the comparison with Web3 and SMTP, the mail transfer protocol, with the idea that people would somehow be interacting with a blockchain. Excuse me, I'm out of time. If you could respond to the Moxie Marlin Spike article that you're no doubt familiar with on my first look at Web3 and respond for writing, I'd appreciate it.
Gentleman yields back. Thank you for respond to his question in writing. Now we'll turn to the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you to our distinguished chairman and our ranking members for holding this hearing, and thanks to the witnesses for sharing your time today. Mr. Chairman, I kind of feel like a NASCAR driver, but I'm not sure which cap to wear, my ag cap or my financial services cap today, but I'm honored to get to be a part of this hearing and hear from these august witnesses. We'd like to begin today with Mr. Culkin. Under Mr. Massad's suggested approach, exchanges that don't list Bitcoin or Ether would be excluded from regulation. Mr. Massad testified that U.S. exchanges collectively list around 400 digital assets. The SEC has indicated that there are nearly 10,000 digital assets being traded on hundreds of platforms. Do you think it is problematic if we don't regulate the trading of digital assets and exchanges that don't list Bitcoin or Ether for trading?
So, Congressman, thank you for the question. There are a number of digital commodities in addition to just Bitcoin and Ethereum. And I think, to Mr. Durgee's point earlier, that trend will continue. And so creating an artificial restriction to only include those digital commodities, I suspect we would be back here speaking with you again in the future.
Again, Mr. Culkin, I've heard some of my Democratic colleagues, particularly on the Financial Services Committee, claim that because Gary Gensler has declared that nearly all digital assets are securities, that we should just treat them all as such. Do you think this is the right approach, to do nothing and let Mr. Gensler just have full control of the space?
So Congressman, I don't, but I don't think that that's the best approach, because nearly 70% of digital commodities traded today have already been deemed commodities by the CFTC as a body, as opposed to any chairman, commissioner, or staff. And so I think we need to be thoughtful about which products are commodities and should be treated as commodities, just like oil or soybeans or interest rates.
I personally would liken Chair Gensler's approach to my son Sam's approach. He's 2 when it comes to toys. He wants to hold all the toys, but he doesn't want anyone else to be able to play with the toys at the same time. And so I thank you for your answer. Mr. Santori, Mr. Massad testified that Congress should not pursue legislation creating new asset classes under the jurisdiction of the CFTC or the SEC because it would generate confusion and lead to disputes. Do you agree?
Thank you for the question, Congressman. I don't agree. I think that what we have today is abundant confusion and complexity. We have two of our financial regulators here in the United States alleging contradictory positions over the same asset. They have alleged that the same asset, one under oath, sworn in a complaint, is both a security and a commodity, but it doesn't fit into the narrow classifications of assets that can be both, the future. What we have today is the untenable position. What we have today is the unending complexity and litigation that is leaving consumers unprotected and leaving us as a global organization unable to plan and unable to invest here in the United States.
Mr. Culkin, would you like to respond to that as well?
No, I agree with Mr. Santori.
Thank you. Mr. Santori, it is essential for any market structure legislation to set rules for the custody of digital assets so that customers can have confidence that their digital assets actually are where an intermediary says they are. Digital assets raise, of course, several novel issues when it comes to custody that must be addressed. Mr. Santori, as we think about how to apply these protections to digital assets, do you have any recommendations for how we should address issues related to custody?
Thank you for the question, Congressman. Custody is something we believe that is critical to consumer protection. We believe it's critical to our ethos. It is part of Kraken's ethos. The failings that we've seen over the last year have had quite a bit to do with lax corporate governance controls, among them being custody. Kraken does offer custody for its users. We segregate our users' funds and their assets. But I will say that there is no such thing as physical segregation on a blockchain because these assets are digital. They are not physical. Custody is an important thing to get right for this Congress. I would say that the most important element of this is prescribing uniform standards for custody across market participants so the consumers know how their assets are being custodied and that they can have confidence in it.
Thank you, and I yield back, Mr. Chairman.
I thank the gentleman. Ms. Bodinsky from, what state are you from?
Illinois.
Illinois. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the ranking members. And thank you to the panelists today. I appreciate your testimony. As we participate in these important hearings on the future of digital assets, it's very clear that there is a pressing need to develop regulatory framework for this industry to protect consumers while also allowing room for growth. I was really happy to participate in the sub-hearing we had on the House Agriculture Committee not too long ago. But maybe zooming out a bit on this topic. At the same time, I hosted a town hall, my first town hall as a freshman in my district last week, and we talked about a whole host of issues from the Farm Bill to the debt ceiling. And yet I don't hear a lot about these issues from my constituents. I represent a very rural part of our state in central and southern Illinois. And so I'm asking to all of you as panelists, how do we frame this conversation for folks like myself back home when we're talking to constituents as it relates to the vision for DeFi to be a supplement to those who have been underrepresented in the traditional finance markets in particular? I'd be interested in your thoughts. Thank you.
Well, if I may address that, I agree with you, Congresswoman. These issues obviously aren't central to most Americans who are worried about whether they'll have a job, whether their incomes will rise, the price of goods, education of their families. What concerns me, though, is what we saw when crypto prices really rose quickly were a lot of people who thought, oh, I'm going to invest in this and I can quickly make some money. And, maybe they even understood that there was volatility to the assets, although I think a lot of them didn't understand that. But there's also a huge amount of risk in these platforms. And so it's maybe not that important an issue for most Americans, but I think we have a responsibility to create an investor protection regime so that they're not taken unfair advantage of. They're not risking their hard-earned savings on things where there's so much fraud and scam and risk.
Congressman, if I could just add, when I try to explain to friends and family that the CFTC has enforcement authority, which is really reactionary, but that they do not have regulatory authority in the commodity spot market, frankly, they're surprised. It's confusing, it's complicated. And so, in my mind, the best incremental step forward here is to expand the CFTC's authority so that participants, particularly retail participants, have the protections that a lot of them think they already have that don't exist.
Additionally, up until recently, unaccredited investors could really only participate in post-IPO offerings. Most of the larger gains take place pre-IPO. So when we look at access and inclusion, in particular in districts like yourself, where those individuals don't have the ability to even participate. And so due to U.S. accreditation laws, it creates an even greater wealth disparity between those two people. So when the crypto markets became activated, particularly in the U.S., and you started to see U.S. retail investors participating, it was almost their first glimpse at participating in what would be considered an early stage startup that they could never have touched otherwise. Now, if we had clear regulatory frameworks and consumer protections where they had the ability to participate within those markets and there was some level of oversight, then they would be sitting in a much better position than they are now and still able to participate in something that's early that otherwise they never would have been able to touch.
Yeah, those are great points. Thank you. I had just one other follow-up question with my remaining time for Mr. Massad. Your testimony touched on the resources that would be necessary to equip the CFTC should they be given additional regulatory authorities. Could you walk us through resources the agency identified or invested in during your time at the CFTC in relation to digital assets and any additional resources we should be looking at now?
Thank you, Congresswoman. It was still a fairly small market when I was in office. I left in early 2017, and we did not, under my tenure, approve any futures products. There were only swaps trading on, platforms with eligible contract participants. So in terms of our regulatory authority, it was fairly small at that time. Obviously, with the overall growth of the market and the fact that we now have several platforms trading derivatives on crypto, it's a much bigger challenge. And if you then go and give the CFTC spot market authority, and I think they're very competent, they could do that, but only if they get adequate resources, because it's just a big policing job.
Thank you, Mr. Chairman. I'll yield back my time. Thank you.
Gentlewoman from Illinois yields back. The gentleman from Oklahoma, the former chair of the House Agriculture Committee and a great American, Mr. Lucas, recognized for 5 minutes.
Thank you, Mr. Chairman. I very much appreciate that. The EU recently approved its markets in crypto assets regulation, and the UK is currently crafting its own framework. Mr. Santori, as other jurisdictions craft their own frameworks and more time passes without a digital asset market structure framework in the U.S., how does this make our job more difficult as we write the rules of the road here at home?
Thank you for the question, Congressman. Other jurisdictions are indeed pushing ahead. They have been pushing ahead. These are G20 jurisdictions with sophisticated financial services markets, with sophisticated technology industries. The U.S. is significantly behind in that respect. It's important that we get it right and not necessarily get it first, but I can tell you firsthand, as a global business with a global footprint, we have made plans to invest in Europe. We are making plans to invest in the United Kingdom. Our plans to invest in the United States by hiring people, by expanding our boots on the grounds operation, well, we're limited in that regard. We find it quite difficult to figure out just how much we should deploy in terms of resources here without a comprehensive federal plan.
As we continue this discussion and work towards legislation, we should keep in mind that the United States, of course, has the most efficient, most liquid, and the deepest capital markets in the world. And this is a result of our willingness to embrace innovative technologies, not stop innovation in its tracks. Mr. Blogrand, could you touch on this? You touched on this in your testimony, but from the perspective of the world's largest stock exchange, could you elaborate generally on both the difficulty and importance of balancing financial innovation with investor protection?
Certainly, thank you. I think you placed it very well. Balancing investor access and investor protection is a crucial exercise. And certainly the framework that we see in the national securities exchanges is one model which may lend itself well to this more nascent space. In particular, the segregation of roles between an exchange and a broker, between an exchange and a clearinghouse and a custodian, that's really basic risk management and can give the public consumer, the public investor, confidence that they're not going to be to use a crypto term of art, rugged.
Following up on that, you discussed how the regulators could choose to provide relief for exchanges that want to list digital assets. From your perspective, what SEC and, for that matter, CFTC rules should be altered to address this?
I think the first issue that needs to be addressed is really a chicken and the egg problem. Right now, there are prospective issuers who are reluctant to pursue registration because there aren't exchanges, sort of capital E national securities exchanges on which they could trade. And national securities exchanges are reluctant to enter the space because there are no listings that have been effective under the SEC. So I think the SEC needs to consider some sort of on-ramp to allow for existing tokens to come into the regulatory fold and find a way that we can sort of end this chicken and the egg situation.
Mr. Santori, you discussed that a major barrier for digital asset trading platforms is to register with the SEC. Is the direct interaction with retail investors rather than through broker-dealers. In your view, what revisions are needed to current law as it relates to broker-dealers in order to have a digital asset trading platform to be successful? And what are the characteristics of digital assets do you believe that make this necessary in my remaining time?
Thank you for the question, Congressman. We believe that the broker-dealer construct is a flexible enough construct to accommodate a great deal of trading in digital assets. Broker-dealers can interact directly with consumers and investors. They can elect under Reg ATS to operate essentially as an exchange. This flexibility is, I think, critical to the task in front of Congress today. And you can contrast that flexibility with the rigid regime that exists for national securities exchanges that require intermediation, require that assets not trade after hours because of the price pressure that occurs on that trading after hours, require transfer agents, which are one of the extractive intermediaries that are obviated by digital assets and blockchains. We think that the SEC still has a role over the future of digital asset trading, and the broker-dealers, specifically the ATS regime, is an excellent fit.
Thanks, Mr. Santori. Gentleman's time has expired, and the committee is very pleased that the witness from New York Stock Exchange used an ag analogy of chicken and egg. We're grateful for that today. And now I turn to the distinguished ranking member of the full committee, Mrs. Waters, for 5 minutes.
Thank you very much. I'm going to address this question to Mr. Blaugard. As I mentioned in my opening statement, this committee has heard from a wide range of market participants about the need to address discrete risk posed by stablecoins, which would be subject to bank-like runs similar to what we saw with SVB and previously with money market funds. We have also heard about the need to enhance the SEC's authority because it is currently limited when going after firms overseas, and the need to enhance CFTC's authority because it currently lacks authority over so-called spot markets. However, there's a broader effort underfoot to establish an entirely new market structure for cryptocurrencies and their issuers. I think that we should first pause and consider whether our securities and commodity market structure is sufficient to address these issues. For 90 years, the New York Stock Exchange and other market participants have been highly regulated to enable American companies seeking capital to gain the trust of investors who have it. We often talk about how our capital markets are the envy of the world, and it is our securities laws that make that so. Your exchange must abide by strict rules about what it can and cannot do. This is a result of regulation designed to protect investor assets by providing the markets with material information, eliminating conflicts of interest and risk to our financial system, and promoting fair competition. In your view, are crypto exchanges meaningfully different from traditional exchanges such that they should warrant an entirely new legislative and regulatory framework? What would be the effect of crafting a new and separate legal framework for crypto exchanges?
Thank you very much for your question. I think it's a general principle that like functions should be regulated in like fashion. And while it is true that the digital asset trading platforms have commingled many of the functions which in the traditional markets are discretely highly regulated, like brokerage, exchange, clearing and custody, the fact that they've commingled them doesn't decrease risk, it increases risk. So in our mind, bringing those activities up to the standard that have been established for national securities exchanges is an appropriate posture. To your second question, we're certainly concerned that should there be an alternative, lighter touch treatment that's developed for digital assets, that there's the risk of regulatory arbitrage that's established, and that would somehow diminish or degrade the investor confidence, the resiliency, the transparency, and the leadership of our more traditional markets as well. There's certainly adaptations that the regulatory agencies should consider with respect to digital assets and refining the way that they're supported, but we believe that they have the authority they need today to do so.
Thank you very much, and I yield back the balance of my time.
She yield back?
Yes.
Gentlewoman yields back. Mr. Stahl of Wisconsin is recognized for 5 minutes.
I thank the chairman. I thank both our chairmans and both our ranking members for calling today's hearing. It's great to see agriculture and financial services come together to address a really big challenge. Why? Because I think it's time for Congress to get to work on digital asset rules, because the current regulation by enforcement practice is not working. Last month, the Financial Services Committee, we asked the SEC Commissioner, Chairman Gensler, for his view on the future of digital assets regulations. And candidly, we didn't learn a lot. We didn't hear a path forward for digital asset regulation. Maybe one of the only things we learned was that Chairman Gensler's never traded a digital asset himself. We don't know what Chairman Gensler's plans are. There's not clear rules in front of us. And regulation by enforcement doesn't work. And the come in and register black box served, the register by black box is serving to chill the digital assets innovation. I don't think we can afford as a country to cede regulation to other countries. I'm concerned that it's going to move innovation outside the United States, move it overseas, costing Americans jobs and putting U.S. retail investors ultimately at a disadvantage. And I think this hearing demonstrates that Congress is ready to do the job. Let me dive in and ask a question, if I can, of you, Mr. Schoenberger. In particular, when we think about the global construct, right? So if we fail to do this here in the United States and we see innovation move abroad, I want to look at what other countries, what other regions are doing. In particular, how do regulators in Europe view blockchain technology? And in particular, how does this attitude differ from that of U.S. regulators?
Thank you, Congressman, for the question. So I can speak for the Web3 Foundation that took a very deliberate decision at the time to be headquartered in Switzerland. Switzerland provided very early on for a very clear regulatory framework, distinguishing between payment tokens, security tokens, and utility tokens. And also the Swiss regulator, FINMA, issued a no-action letter to the Web3 Foundation back already in 2019.
So would it, only cognizant of my time, would it be fair to say that they took a much more forward-thinking approach in Switzerland and in Europe?
I would say so. I mean, this framework that they provided certainly provided the legal certainty to be headquartered there and have legal clarity around the classification instantly.
Thank you very much. Only cognizant of my time. If I can, Mr. Durgee, if I can shift over to you. We look at the European Union recently approved its market in crypto assets regulations. What lessons can we take away from the EU's experience as we craft our own market structured laws here in the United States?
Yes, thank you for the question. As we look at the rollout of MiCA, which won't take place actually until 2024, it really is the first large-scale jurisdictional regulatory framework that we've seen from a major market. It's very focused on retail investors, in particular protecting them in the earlier stages of these projects and the project development, but I would say it would be a misstep to only look there. If we look at other jurisdictions out of Dubai, like VARA, we look at MAS out of Singapore, we look at what South Korea is doing, particularly around security tokens and gaming, you start to get a much more holistic view of how the world is approaching the asset class as the United States starts to wait in the wings.
And as those countries have more stability, more clarity, not driving forward through a regulatory approach, but putting forward rules and regulations of the road, do you see more investment and innovation occurring in those jurisdictions?
Extensively so, and the real example is, I think I'm the only one here that actually runs early stage venture funds. We have multiple out of Republic that we run, and in the last 3 years there's been a huge shift to offshore investments. I'd say we're doing over 3x investments now offshore as we worked in the U.S.
Thank you very much. Cognizant of the time, I'm going to jump, if I can. One final question to you, Mr. Santori. We've talked about the Howey test, how it's used, and in particular, do you think this efforts of others requirement is triggered when you have a digital asset project where holders contribute to the development and success of a functional or decentralized network?
Thank you for the question, Congressman. No, I don't. I think that's actually quite rare. I think that the attraction of blockchain networks is, among other things, the ability to coordinate between large, otherwise disorganized groups whose efforts contribute to the code, but don't act together as issuers, who don't exercise managerial expertise over profits and losses. This is a very different environment than what was contemplated in Howey and its orange groves.
Thank you very much, because one of the, as we all know, the requirements of the Howey test is that the profits be primarily derived from the efforts of others. I think your comment there is helpful. Mr. Chairman, I yield back.
Gentleman yields back. Gentleman from North Carolina, Mr. Davis, is recognized for 5 minutes.
Thank you so much, Mr. Chair. And I'll say good morning to all the witnesses today. Thank you so much for joining us, and especially to my colleagues too on the Financial Services Committee, as well as those on our House Agriculture Committee. Looking at the Pew report or research that was done, and this particular data point is showing as high as 66% of minority communities using, and this is self-report, by the way, U.S. adults that are self-reporting having traded or used cryptocurrency. And my question here is, I've looked at different research that's been out there, just trying to get an understanding of what's taking place. And I'm just wanting to understand, as we're here trying to discuss regulation, how do we best understand right now in terms of the data and what's actually taking place before us?
Well, if I may answer that, Congressman, I'm very concerned by the statistic you cited. I think it does suggest that a lot of people might be jumping into this space not being fully aware of all the risks. I think we certainly saw that as prices started to go up dramatically in crypto. And I think it just speaks to the need to create a much better investor protection framework. We do not have that today in this industry.
If I could add, Congressman, this discussion is not just about people using tokens or people using digital assets. This discussion is about people using the product of those digital assets, the functional use cases that exist today, and this Congress has heard from witnesses who have laid bare some of those uses. I can add a couple to that pile, but maybe one in particular that I think illustrates that distinction between the use case and the coin. Today, when you watch a video on your phone, and we've all probably watched videos on our phone from time to time, those videos are recorded in far-off places using different standards, resolutions, color schemes, et cetera. Transforming that into a version that fits on your phone takes computing and processing power. It takes time and effort, and it's expensive. There are blockchain-based networks now that coordinate and incentivize that process. It's called transcoding, so that end users can see that video that's being recorded at a different resolution on their phone, on their screen, on a big screen, on IMAX, right? People are using that technology today to view videos of all kinds, mundane use cases that have nothing to do with blockchain technology, but those use cases are being provisioned and delivered because of functional networks in digital assets. Kraken doesn't provide that. We would be the subject of regulation. We only provide liquidity services, but we're a part of that ecosystem, and that's part of this conversation today.
Yeah. When I think, broadly speaking, and we look at recent market, what's happened with the market in terms of crashes, and I come back to just trying to piecemeal and understand the dynamics of what's taking place, you know, it would be concerning at how we're able to identify, you know, certain trends in the data. And what would be important to me when we obviously are talking about safeguards, consumer protection, you know, fraud scams that are taking place, at how we are proactively looking at any trend lines to further protect consumers. And I would love, with the time remaining, if anyone would like to just add another comment on what that looks like, identifying any trend lines that would be of concerning when we're talking about putting safeguards in place for consumer protection.
Yeah, Congressman, if I could, I'll maybe offer that. I think right now, market participants see press releases where regulatory agencies like the CFTC are bringing cases in the spot market for trading of things like Bitcoin, Ethereum, certain stable coins for fraud and manipulation. And so they assume, or they think, that the CFTC has full regulatory authority for those markets, and they don't. And so they later find out that customer funds aren't being segregated, the markets aren't being subject to surveillance, they're not getting specific treatment under bankruptcy. And so there's an effort that could be made to expand the authority, which would then go to further education of the market.
Thank you. I yield back, Mr.
Thank you, Mr. Davis. Mr. Davis yields back. Mr. Timmons of South Carolina is recognized for 5 minutes.
Thank you, Mr. Chairman. The question, is a digital asset a security, really is a question of should existing securities regulations apply to digital assets? It seems to me that the answer is no. Blockchain technology enables digital assets to be created, stored, transferred, and transacted. The use of digital assets is essential to our discussion here. Some are cryptocurrencies intended to be used as a means of payment to buy goods and services. Some are digital assets intended to represent traditional assets, such as equities, bonds, or derivatives. Some are digital tokens intended to provide access to and operate blockchain-based infrastructures. Further still, digital assets have different funding structures at their inception, different governance structures, different operational rules, and different marketed economic realities. Existing securities regulations simply do not have the appropriate flexibility to foster innovation and support the adoption of blockchain technology in all of its use cases, while also providing the necessary investor protections. Here in Congress, we face a daunting task in navigating these regulatory waters. I believe Congress must act to clarify the regulatory uncertainty. Digital assets will be a huge part of the global economy in the future. The strength of our markets and the rule of law in the United States gives us the ability to lead in the future of digital assets. That ability to lead is also often a burden. It is a burden that we are obligated to rise to the occasion and meet. So the purpose of this hearing is to identify what future framework will best meet the needs of the digital assets industry while protecting our citizens from foreseeable harm. Along those lines, I have a few questions around whether existing securities regulations should apply to digital assets. One of the hallmarks of digital asset that has reached its full potential is being functional and decentralized. Mr. Schoenberger, would you discuss what it means for digital asset to be functional and decentralized, and why these features have become the end goal for so many digital asset projects?
Thank you, Congressman, for the question. Well, I would say this is certainly true for DOT and some other projects, probably not for all. For those where that applies, we need to go back to the Web3 vision that is based on community consensus, and this necessarily requires that there's no central entity controlling the network. And the Web3 Foundation, during the launch of the Polkadot network, gave up control over the network and handed that over to the community very early in the game. So that's the decentralization part. Being functional simply means some token needs to be more than simply a means of payment or a vehicle for investment. In the case of DOT, again, this gives you access to the network. It's used for securing the network. It's used for participating in the governance, and also if you want to lease a blockchain on top of the network.
Thank you for that. One follow-up. In your testimony, you said that when the foundation removed the pseudo key, it was a pivotal point in decentralizing the Polkadot network. Would you explain more about that process and how it ensured that the foundation could not control the network anymore?
Sure. The pseudo key gives super user capacities, like gives you the abilities of a super admin. This key, together with the abilities, was given up, and since the code is all open source, this can be looked up by literally everyone. And once this was handed over to the community, the whole control over the network, to reinstate this would take a majority vote of the community.
Thank you for that. We've discussed today that either legislation or adaptations are needed. I want to discuss that more. Bitcoin is the most popular digital asset in the ecosystem. It is also the only digital asset that both the SEC and the CFTC can agree is a commodity. Mr. Santori, under the current securities laws, would it be possible for a national security exchange to list Bitcoin and a security alongside each other?
Thank you for the question, Mr. Timmons. No, it wouldn't. National securities exchanges are limited in the assets that they can list, and it's not just a question of amending the list of assets they can list. It's a matter of ripping the heart out of the rules that are in place that make that listing possible. The limitations on trading times, the requirement of intermediaries that can be expensive, the requirement that they don't list additional assets. These are fundamental to the structure of the national securities exchange that exists in the United States. It is not a flexible one.
Thank you for that. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Illinois, Mr. Cassidy, recognized for 5 minutes.
Thank you, Mr. Chairman, and to all our witnesses here today. I have just a general request, and I feel like I make some version of this at all our meetings. If a carpenter asked you, why do I need a screwdriver, and you said, let me tell you why all carpenters need to use toolboxes, we'd say you're not answering the question.